if you look at the stock market right now, with the new administration kind of coming in, stock market is like crazy, right? You see the investors are kind of sitting on the fence right now, right? What's your outlook for the future?
Everybody understands the 30-year fixed rate mortgage where you take out your loan on your home, your personal residence, none of which are perfect. Each have their own advantages and disadvantages.
Worse than if they, to begin with, they had adjustable, they were still like locked in for a few years. So they might had another 2 3 years into that interest rate, right?
4 years ago, you might pay $30,000 to get an interest rate cap that would cap your interest rate at, say, 4.25%.
What are the other factors that you see that is causing this dislocation? So financing, we talked at length. Financing is one. Dig deeper into the other factors. Welcome back to another episode of Bigger Life Podcast, where we dive into the world of real estate investment, sharing valuable insights and strategies with you, our listeners, to help you grow your wealth and live a bigger, better life. I'm your host, Ray Bansal, and today I have an incredible, exciting guest with me. Joining us today is Brian Burke, President and CEO of Praxis Capital, a vertically integrated real estate private equity investment firm that he founded back in 2001. With over 30 years of experience in real estate, Brian has acquired more than 800 million in real estate, including 4,000 multifamily units and over 700 single-family units. He's also the author of Hands-Off Investor, which is a must-read for anyone interested in passive real estate investing. Brian, thank you so much for being here. How are you doing today?
I'm doing great, Ray. Thanks for having me on.
Well, we are thrilled to have you. Let's jump right into it. So you have such an impressive career. Let's start off. How did you get started, right? So what was the beginning of it?
I started like a lot of people start their real estate investment journey, and that is with no knowledge, no money, no connections, and no contacts, and no real estate. I read a book on investing in real estate and thought this sounded like a great thing for me. And I also read that you could do it with no money down. So my very first real estate purchase was a rental house. I didn't even own my own house. I bought a rental house with no money down. I got the seller to carry back the down payment. And then I was hooked. From there, I went into flipping houses, and I was a small-time house flipper for a number of years while I was trying to figure out how to become, a big-time house flipper, for lack of a better term. Finally managed to figure out how to do that and grew my house flipping business into one where I was doing about a couple dozen houses a year. And then the 2005 real estate collapse came along. Fortunately for me, about a year or so before that, I really stopped buying anything because nothing made any sense. So I scaled my business way back. Didn't get bit too hard by that 2005 real estate collapse, even though it was a painful experience. It could have been a lot worse. Survived that and came out of it the other side with a massive house flipping business where we were doing over 100 houses a year. And through that process, I started observing that, we were raising a lot of money from investors to fund all these acquisitions and renovations that we were doing. And I knew pretty soon all these foreclosures are going to be gone and the deal flow is going to dry up. And I really need to figure out a way to have a sustainable and scalable business for the long term. How am I going to do that? And so I turned to my old friend, multifamily investing, which is something that I had gotten into on a personal level about 22 years ago, and really started focusing our business more onto the multifamily side because it was scalable and it was sustainable and we could do it across market cycles, and turned our focus to multifamily quite a few years ago, and really have never looked back. That's been the main focus of our business ever since.
Awesome. Great. So you have been timing the market in that sense, right? So you kind of figured, okay, 2005, it seems like nothing is making sense. Let me not buy it, but rather focus on the different side of the business.
I mean, I think market cycles are a big deal. I mean, people say like, "Oh, you should always be buying real estate. Invest no matter what." Dollar cost average. There's people that believe in that thesis, and I'm sure it works great for them. For me, I've had better success observing market conditions and trying to react to them and get in front of them. So we did that in '05. I kind of really gated back my buying in about '04. '05, '06, hardly bought anything during those years. But then, 2008, after prices had really fallen, it was 100%, 90 miles an hour with your hair on fire 7 days a week. Kind of did the same thing again here in 2022, when multifamily values started tumbling about almost 3 years ago. 4 years ago, we started aggressively selling our portfolio. We'd built up about 4,000 units, started selling, managed to sell about 3/4 of our portfolio before the market started collapsing. And then, as soon as it troughs out, then we're going to get back into buying again. And they always say that the way to success is to buy low and sell high. And I really like to do it that way. I mean, some people really like to buy high and sell low, but that hasn't really worked very well for me.
Absolutely. So, do you see a pattern into the market, like, into these cycles?
There's definitely a pattern, and usually you can find this pattern from the psychology around the cycle, and not so much looking at measurable metrics like people tend to look at, although that does play a role. I mean, thinking back to '05, when people would say like, "Oh, I've got to buy a rental house," and it would be like, "Well, why do you need to do that? They're $500,000 and they rent for $1,500 a month. That doesn't make numerical sense." So right there, there's some kind of a problem afoot. But more importantly, it was that everybody was doing it. And it's kind of like when everybody piles on, that's usually a good time to pile out. We saw this in the 2000 dot-com bubble in the stock market, where literally everyone was buying tech stocks in 99 and 2000. And then all of a sudden, boom, the whole thing implodes. Stocks fall. People are losing their shirts left and right. And it was chaos. You get the same thing that happens in real estate cycles. And then to find the bottom of the cycle is usually when you have the most negative sentiment. When people say like, I wouldn't invest in real estate if you gave it to me. Well, that's probably a really good time to buy real estate. Is a time when it's unpopular. And so you can kind of look at these, the the psychology surrounding the market to get clues into where the market may be headed next.
So, what's your outlook for the future years? So, how do you see 2025, 2026, or beyond? So, when do you think is the next buying cycle? If you look at the stock market right now, with the new administration kind of coming in, stock market is like crazy, right? Fed, the indication is that the interest rates will kind of go down. Uh, how soon they go down or how fast they go down, that's another story. But general sentiment is that interest rates will drop at some point of time. People from a residential standpoint, you see the investors are kind of sitting on the fence right now, right? And kind of watching your timing. What's your outlook for the future?
Well, somebody came up with a phrase about 2 or 3 years ago when interest rates started going up and they were getting distressed because their adjustable rate loan payments were increasing and maturities were facing them, were facing them, and they were worried that their loan was going to come due. And so somebody invented this saying that said, "Survive till 25." And the belief was that if you could get until 2025, you could buy enough time to get until 2025, then interest rates were going to come down and financing was going to be more available, and everything was going to be fixed, and everything was going to be great. I never really quite believed that saying. My saying is more, I kind of came up with my own sayings where it's like, okay, I think it's going to be fixed in 26. Or maybe you could say, you'll be in investor heaven in 27. Or maybe you could say, if you wait till 28, you'll be too late. I mean, those I think are a little bit more descriptive of where I think we really are. I think 2025 is going to be a transition year where The first thing that has to happen before prices go up is they have to stop going down. And I think 25 is likely to be that year when I think, rents will probably bottom out and we'll start to see rent growth again. Pricing will probably bottom out. Construction activity is going to top out, and deliveries will start to and deliveries are kind of an inverse indicator to market conditions for rent and price growth. When these deliveries top out, then that's going to support additional pricing and rent growth. So I think 25 is going to be a bit of a transition year. Hopefully we'll see the bottom happen in 25. I don't know for sure that it will, because there may be a little bit of a hangover from debt maturities and owner distress, borrower distress, that may carry out into 26, and it will mean that the bottom could get stretched. But I think we're going to see it. I think we're going to see it happen within the next year or so, and that's going to present a really good buying opportunity. And I think that buying opportunity is going to last a little while. We'll have a couple of really good years of buying at a really reasonable basis. If we can get buyers and sellers on the same page. I think the fundamentals for multifamily specifically are very sound. Fundamentally, and I think we're going to see some better times ahead than we had seen over the last 3 or 4 years.
And majority of the funding in the multifamily space is adjustable rate mortgages, right?
Well, a lot of it is, not all of it though. So there's different financing vehicles in the multifamily space, and they each have their own specific use. I mean, to keep it to simplify it and bake it down, to something that everyone can understand. Everybody understands the 30-year fixed rate mortgage, where you take out your loan on your home, your personal residence. You've got a fixed interest rate. It's fixed for the entire 30-year life of the loan. If you make payments for 30 years, it'll be completely paid off. There's no balloon payment. That's a great financing vehicle, by the way. But the only thing is it doesn't exist in the space of commercial real estate, including multifamily. That product just simply isn't there. So instead, you have to choose between this menu of financing alternatives, none of which are perfect. Each have their own advantages and disadvantages. So the most similar product that you would find is a 10-year fixed rate agency loan from Fannie Mae or Freddie Mac. There's other lenders like life companies might do this too. And in this case, you have a loan where the interest rate is fixed. You make payments for 10 years. Some of that period might be interest only payments, and some of that might be amortizing. But the loan never pays off, because after you get to 10 years, it's now time to either pay it off by selling the property or refinancing the loan. You can't just make payments until it's fully paid off. There is a balloon payment. And that's a great financing vehicle, but there's a downside to it. And that is that when you take out such a loan, you're basically guaranteeing the lender that they're going to receive 10 years of interest. So if you were to have an opportunity to sell your property, or in fact, a need to sell your property, let's say in year 3, you're still going to owe that lender 7 years of interest, because when you signed up on a 10-year fixed, you guaranteed they're going to get that interest. So there's a prepayment penalty called yield maintenance, and there's another mechanism called defeasance, which is a little bit more complicated, but nevertheless, it's punitive to try to get out of those loans. So that's the downside. The upside is what your interest rate's going to be. The downside is it can be very, very punitive if you had to sell or refinance. So there's another product called a floating rate loan, where in this case, you could get a loan for 5, 7, or 10 years. The interest rate floats, tied to the secured overnight funding rate. And you don't have this yield maintenance issue. You're not guaranteeing the lender they're going to receive payments over the life of the loan. You still will have to pay off the balloon payment in 5, 7, or 10 years by refinancing or selling. But you don't have this prepayment penalty if you were to sell. Let's say you have a 10-year loan and you sold in year 3, your only prepayment penalty is a 1% exit fee. So it's very manageable. The downside is you have to be able to accept and tolerate interest rate risk. So a lot of deals out there were financed using this vehicle. And then there's a third vehicle out there which has a specific purpose, and it's called a bridge loan. And the bridge loan's specific purpose is to take an underperforming property and allow you to take out debt against the underperforming property as a temporary loan while you renovate, fix it up, re-rent it out at higher rates, stabilize the property, boost the occupancy, contain the expenses, whatever the issue was that caused the property to not qualify for fixed or floating agency debt. And the bridge loan has a couple of risk factors. One is that it's has a floating interest rate, so you have the same interest rate exposure as you do with an agency floater. Um, the other risk factor is that they have a short-term maturity. So these loans might be due in 3 years, and while that may seem like a long time, 3 years in this world can go by in the blink of an eye. So those loans carry a great degree of risk, because if the maturity date arrives at a time when the market is in a down cycle, you've got an extreme problem on your hands. You can't refinance, you can't sell, you get really stuck. And unfortunately, a lot of owners of multifamily and commercial real estate have found themselves caught in this trap because they were using bridge loans more as a crutch rather than as an actual, its true purpose of bridging an underperforming property. Instead, they were using it as a way to gain additional leverage, so they would have to raise less equity capital from their investors. And that turned out to be a very dangerous combination and isn't working out very well for those owners.
And I think that's where majority of that crash is happening, right? Because a lot of people had those bridge loans, what I heard, and now that they have to refi and the interest rates are significantly higher on the adjustable side. Worse than if they, to begin with, they had adjustable, they were still like locked in for a few years. So they might have another 2-3 years into that interest rate, right?
Sometimes they'll have an interest rate cap that locks the interest rate in at a certain rate, but those interest rate caps are not a contractual obligation. Instead, that's a derivative transaction where you're buying an interest rate cap from a derivative counterparty. And while that's all a bunch of complex, financial language, really what this means is that you're transferring interest rate risk to someone else for a fee. And 4 years ago, you might pay $30,000 to get an interest rate cap that would cap your interest rate at, say, 4.25%. But now interest rates have gone up, and that interest rate cap was, let's say, a 3-year cap. And now you're 3 years in, and you have to buy a new cap. The problem that a lot of owners are finding is that new cap, instead of being $30,000, might cost $500,000. The prices went up astronomically, and a lot of owners didn't have that money. They didn't set anything aside for rate cap replacement, or if they got a 3-year bridge loan, there may have been no mechanism for rate cap replacement because the lender is under the assumption that you're going to pay the loan off before the rate cap expires because they were coterminous. So there's a lot of owners that are kind of caught in this whole trap where, they don't have the money to get an interest rate replacement cap. They can't refinance the property because interest rates are higher now than they were. And the property value is lower than it was 3 years ago. So on a loan to value ratio basis, they don't qualify for replacement financing anyway. So there's a lot of owners that are kind of stuck between a rock and a hard place. And that's part of what's creating this dislocation in the market that you're seeing today.
So that's one part. What are the other factors that you see that is causing this dislocation? So financing, we talked at length. Financing is one. And let's dig deeper into the other factors one by one.
Yeah, I think there's basically 4 factors. And I say that, what's going on in the market right now is kind of like a traffic collision in the middle of a 4-way intersection. From one direction, you have cap rates. From another direction, you have interest rates. From the third direction, you have expenses. And from the fourth direction, you have rent growth. All of these things were approaching the same intersection at the same time. All the lights were green and they all crashed in the middle of the intersection. And now there's this big pile of debris that somebody has to clean up. And so that's really what we're faced with. And, cap rates is kind of the way that some people think about real estate valuation, and when cap rates go up, prices go down. It's really the other way around. It's actually when prices go down, cap rates go up, because the cap rate is really the passenger, not the driver. But some people don't think of it that way. The other way is expense growth. Expense growth is a big deal. Inflation has been real. I mean, anybody that shops at the grocery store can tell you that things are more expensive. If you've ever been to a lumber yard recently, you know things are more expensive. And that goes across the board for property operations. So things like utilities, your electric and gas is costing more. Maintenance is costing more, just from the standpoint of maintenance supplies. A faucet might have gone up 30%. And you got to replace a faucet or a water heater. All those things are more expensive now. Labor has gone up. So what you have to pay your manager, your maintenance folks, leasing agents, all those people, they're looking for wage increases because their personal costs have gone up. And all another big one is insurance prices. Insurance prices in some markets have gone up tremendously high, 400, 500%. And when owners were counting on, 2 to 3% increases, you've really blown your budget. So expense growth has been a big deal. That's eroded net operating income. And then from the other direction is rent growth. Rent growth was astronomical right after COVID. I mean, Phoenix, I think, is the poster child for rent growth anomalies, where they had a 40% annual year over year rent growth between 2020 and 2022, and that's just unsustainable. And now rent growth has actually gone the exact opposite direction. Rents are declining, especially in markets that had high rates of rent growth just after the pandemic. Rent growth has now turned negative. So you've got this situation where income real estate is valued based upon the income it produces, and the income is falling because expenses are going up and rents are going down. So that's creating a big issue. And then to make matters worse, you've got interest rates that have been going up at that same moment in time, which has also increased costs, which has impacted cash flow. And as a result, people are sitting on the sidelines and not buying real estate. And that means that resale values have gone down. And that means that, exit cap rates have gone up. So it's been a combination of all of those factors happening all at the same time.
Understand. So Praxis Capital, you say, is a vertically integrated firm. Can you explain for our viewers what does that mean, and how does it benefit your operations, or how do you kind of operate it?
Vertical integration just means that we do everything in-house. So as someone like me that buys multifamily real estate and has funds where investors invest in a fund, and then together as a group we buy a property, some companies will then acquire a property and then in turn hire a local property management company to manage that asset. That management company will hire, third-party contractors who will do repair work and that sort of thing. And kind of like everything is hired out to someone else. In a vertically integrated firm such as ours, we have our own property management company. So when we acquire an asset, we turn the asset over to our internal management team, and our internal management team then is responsible for property operations and asset management, and basically doing everything that is required to own and operate that property. We also do some maintenance work in-house, where we'll hire people in-house to do apartment renovations, maintenance work, and that sort of stuff. We only third-party hire out more larger projects or more involved things that require specialized skills or a lot of personnel. So the advantage to vertical integration is that we have more control over the process from start to finish, rather than relying upon outside firms that we don't have long-standing ties to, who also aren't motivated in the same ways that we are. The folks in our management team participate alongside the rest of us in the outcomes of these assets, the investment performance of these assets, whereas a fee-based property management company would not.
So, when you're evaluating potential properties for your acquisition, what are the key things that you're looking for? And where do you start? I mean, there's so many different dynamics, right? So you can start with the property or you can start with the market. So, can you walk us through the whole uh, quote unquote acquisition strategy here?
Yeah, so we use what I call a top-down, bottom-up approach, which the top-down side of the approach is that we look for markets that we think have a long runway and a positive story. And so one of the ways that I like to articulate that is that we invest in places where people are moving to, and we avoid investing in places where people are moving from, because uh, income real estate is valued by the income, and the income is directly tied to the job growth, population growth, and income growth in that local area. So if we can invest in places where people are moving to, we find that we have population growth. And generally, that also means that there's job growth. And usually that also means that there's income growth. So that we first look for those markets where we can find that job growth, income growth, and population growth. And then within those markets, that's kind of our top down approach. We'll drill down a little bit more to look for areas that are lower in crime, maybe a little bit higher in median incomes and that sort of stuff. And then we begin our bottom up approach where we're looking for assets. Now we're looking at the real estate and kind of coming up from the bottom. It's like, okay, what's the condition of the property? What year was it built? What kind of rents is it getting? How do those rents compare to other similar properties and the rents that they're getting? What improvements might we need to make, and that sort of stuff. So our buy box right now is tends to be more in kind of like growth markets, southern half of the U.S. where people are moving to. Investing in assets that are newer. We like Class A assets built after 2000, multifamily larger than 100 units, 200 and up is even better. That's kind of our like main criteria, and then beyond that, then it's just drilling down into kind of more of the details.
Sure. So, this is how you're looking at the property. Now let's talk about the financial metrics of the same thing, right? So you find a property that kind of fits that general criteria, that buy box. It's into the location, the crime rate, and it's fits the general buy box criteria. What are the financial metrics now that you're looking at from your analysis standpoint to say, yes, this meets Brian Burke's, test, and this is what I'm going to acquire?
Well, one of the first tests and most important tests today, and this is a little bit of a moving target because in different market conditions, the way you look at the financial measurements is going to differ. But right now, when you're in this market where there's uncertainty as to the future, you don't know exactly where interest rates are headed, you don't know exactly what rent growth is doing because we're in this transitionary phase. To me, what's really important is current cash flow because that's money in the bank right now. And so, as I mentioned before, we fund our acquisitions by raising money from investors that invest into funds where we acquire these properties. Now, to get an investor to invest, you have to present them with an opportunity that's better than other opportunities that are immediately available to them. And so I think one of the best examples of that is a money market account. Right now, you can open up a savings account and put your money in a money market fund and earn 4.5% almost risk-free with complete liquidity rights. And that's very difficult to compete with if you're looking at buying, say, a multifamily value add property where year one cash flow, if you're being honest with yourself, is 1%. And then maybe by year three, it's 4%. And then by year five, it's 5 or 6 or 7%. That's been the traditional value add model that a lot of acquisition criteria has been molded around for the last decade. But now, with 4.5% money market accounts, who's going to take their money out of a 4.5% money market account with full liquidity and safety and invest it in a risky multifamily deal for a 1% cash on cash return and the hope that maybe the value will go up later? So right now in today's market, I'd have to see to get me off the fence is immediate cash on cash returns that beat a money market account. So maybe a 5% cash on cash return day one out of the gate on Class A property. That's kind of one of the lower risk buckets of commercial real estate. And then the rest of this is kind of the belief that the market's going to significantly change over the next 5 years. And by the way, I'd have to see that 5% cash on cash return with a fixed rate loan where I can lock in our interest rates. We have, at least some cost control. It's in there, low leverage, probably somewhere in the 50 to 65% loan to value ratio leverage point. Not over levering, so that it's a high hurdle to cross to get 5% at a 55 or 65% LTV on a fixed rate 7% loan when cap rates are in the fives. So it's probably, that's one of the main reasons we haven't bought anything in 3 years, is it's very difficult to find properties that will meet that test. Now, I shouldn't say that. Every property can meet that test at the right price. It's very difficult to find sellers who will part with them for a price that will produce that result. And so that's really what we're waiting for. We need to wait for sellers to be in a position of urgency where they need to sell that property, and that's the best price they're going to get.
So in your fund, the investors that invested, right now you have not acquired anything in for the last 3 years. Instead, you were doing the opposite, where you were kind of selling it, right? Or you kind of timed that. So how are the investors kind of making their returns, or how are you producing returns for them? Are you just producing the returns based on the underlying assets, whatever is left over? Because you started with 4,000, you sold over 3,000. What's left is about 1,000, right? Or you have different funds for different properties, and you're like, okay, fund A is closed, fund B is closed, fund C is closed, but D and E is still kind of pending. So what's your model?
Yeah, it's more like the second version there, where we've had a series of funds that acquire properties during different periods of time. So we don't have an open-end evergreen fund where we buy and then, we raise more money and buy some more and then raise more money and buy some more. These are closed-end funds where we might say like, okay, we're going to raise $50 million. And once that money is spent, that fund is closed. Then we raise another fund. And it's helpful to segregate these things out by vintage that way to a certain degree, because what we don't want to have to worry about is, let's say we buy a property 5 years ago and then it goes up in value, and now we have new investors coming in and they own a piece of this asset that we've owned for 5 years. The other investors have been there the whole time, and now a new person comes in and gets a piece of that without having been there the whole time the other investors were in there. So there are different ways to address that problem, by marking shares to market and other things. But instead, what we chose to do was to just separate those vintages out into separate funds. And so when we started selling, we're on our 7th fund now, or maybe 8th fund. And we were selling kind of in the earlier stuff that we'd had. We started selling those. We got into selling our Fund 6 product, and we sold one property out of that fund, and then had another one in escrow when the light switch got flipped. And so that deal did not close. So I can almost tell you to the day when the market changed, because it was right in the middle of that escrow when that deal didn't close. So we got kind of quote unquote stuck with that one. So the earlier funds that had exits, those funds did remarkably well, as they would in any time when you have a market that's increasing in value. And the 1,000 units that we have left, while they're holding their own, we're in what I call more of a market survival mode, where it's like, look, whatever returns we thought we were going to get when we made this investment, the market is not going to give that to us. Now what we're going to do is we're going to hold on and we're going to sell in a better market. Now, we don't know what that's going to look like. That better market may be so good that we get the same returns or similar returns to what we had originally forecasted, regardless of the fact that we felt a lot of pain along the way. Or it could be a scenario where the market just comes back and we're able to at least get out of them clean, maybe make a few bucks for our trouble and move on. And that's kind of real estate investing in general. Whenever you're investing in a low market and selling in a high market, you're going to do really, really well. And whenever you're investing in a market that turns on you during your hold time, you're not going to do as well, no matter how good you are, smart you are, or how much you thought you timed it. The market is really the one in control.
Interesting. Well, thanks for sharing that. Now, we always talk about closed deal. Let's talk about this deal that did not go through, right? What happened? Did the buyers had a change of heart? The financing fell through, or something else?
Yeah, the market completely turned on them. So, when we went into escrow, the market was still firing on all cylinders. And it's interesting how quickly markets can turn on you. When markets go from a down market to an up market, it's a very long and identifiable process where you kind of like all this stuff plays out. You can almost see it happening in real time. And it's kind of like, watching a traffic collision that you can see is about to happen. You can kind of see it all happening in slow motion. That's a market recovery. It's in really slow motion. When a market switches from up or level to down, it's instant. In my experience, and I've been through this a number of times, it happens very, very quickly. And in a matter of days or weeks, a market can turn from one that's actually very positive to one that's completely negative. And that's exactly what happened right in the middle of this escrow. Things were very positive at the time we went into contract. And then while the buyer was doing their due diligence and lining up their financing, the market began to change. Their lender backed out on them. They asked for an extension so they could go to a different lender. They found a different lender. That lender backed out on them. Their equity sources that were going to fund the equity started backing out. They had, I think, one big investor that was going to contribute a couple million, and that investor said, change your mind, never mind. Other investors that, they're relying on kind of the retail investor, people who are investing maybe $50,000 or $100,000 chunks were drying up. And all that kind of happened right at the same time, and the buyer just frankly couldn't close.
I also know that you have investments into single family homes, right? So how many single family homes do you have currently?
Not many. I've probably only got a handful, maybe I'm sure less than 6 or 7 single family homes left. Everything else is multi.
Okay. And I believe then those are in your personal capacity versus into the Praxis Capital.
That's right. Yeah, we don't do single family homes in our multifamily funds. We do have a fix and flip fund where we buy, fix, and renovate houses, which is a leftover fund from our great financial collapse days when we were doing all the foreclosures. We had a great team in place, and we left them there, and they're still doing their thing, and we're still doing a few house flips a year, not very many. That is something that runs on autopilot amongst that team. So I'm counting those houses. I think we got just a small handful of houses in that strategy as well. But it's much different than where we were in 2018, and I think we topped out at around 120 or 130 rental houses around that time, but started selling those aggressively into the rapidly increasing market.
How has technology played a role into your success? Because everybody uses different kind of technologies to either evaluate or manage the things from an overall real estate investing standpoint. So, what role is technology playing for you? What kind of tools are you using to do that?
It's played a big role. I mean, when I first started in this business, literally email was just being invented. That's how long ago it was that I started investing in real estate. And back in those days, when I was buying houses at foreclosure auctions, everybody would show up at the foreclosure auction with a manila file folder full of papers. And then when the next house was going to be called for auction, they're thumbing through all these papers and trying to figure out what was going to sale. And I remember back then I thought, there's got to be a better way to track this stuff than the way that these guys are doing it and the way I was doing it, by cutting out the public notice out of the newspaper and literally taping it to an 8.5 by 11 sheet of paper and writing my notes on there. Right. So I learned how to write my own software, and I wrote my own software platform that would track those foreclosure auctions. And also I could run my title searches through it and do all sorts of stuff that really transformed my business and gave us a tremendous advantage in the house flipping side of our business. And it was that house flipping side that gave me the ability to transition into multifamily eventually. So if it wasn't for having taken that step, I certainly wouldn't be where I am today. But even since then, we've grown our technological resources considerably. I mean, now you've got even just such simple things as Google Maps with Street View and the ability to drive down any street in America from your desk. I mean, imagine that 30 years ago when, it's like you had to get on a plane and fly out there just to see what was next to the property that you were looking at buying. Now you have so many more resources. But even going beyond that, now with the introduction of artificial intelligence, we're using artificial intelligence extensively in our asset management side for assisting us in setting rent levels, handling resident maintenance issues, and collections, and getting people to pay their rent, managing leads and prospects through the leasing process. There's just a number of ways that we're leveraging artificial intelligence resources now to make us more efficient asset managers and property managers. So, technology has made such a big difference that it's allowed us to grow, into the thousands of units with a very skeleton crew. We don't have to have a lot of people on the, kind of capital and asset management side. On the property management side, that's still a very human resources intensive segment of the business. But on the corporate level, we've managed to grow quite considerably with, a very reasonable sized team that, we didn't have to get too big, that we had this huge overhead when the market turned on us. And, it's technology that's allowed us to be able to do that.
How do you foresee the role of real estate syndication evolving in the future? Because there were a lot of syndicators that kind of came to the market, right? And for let's say short duration of time, people got returns. But now with this whole, let's call it trauma, trauma going on into the industry, people who have invested, some of them, and now they have calls after calls to put more money into the syndications, right? So not all syndicators are the same. Obviously, there are ones who kind of like you, who foresee the thing, then they make better decisions for their investors. But at the same time, a few bad apples can bring a bad name to the industry. So how do you see that? I mean, investors are concerned, individual investors.
Yeah, investors are rightfully concerned. And, if you look at the profile of the, quote unquote, real estate syndicator over the past 5 or 6 years, that profile hasn't really been what you would consider to be ideal for a sophisticated investor who's really concerned about managing risk. There was a lot of investment dollars being driven towards early stage fund managers who didn't have a lot of real estate experience, if any at all, in some cases, and were growing businesses rapidly in a long in the tooth bull run market. And, this goes back to my earlier comment before about, one of the things that identifies the top of a market is when everybody starts piling in. And we started to see this even accelerate in 2021 and 22 with inexperienced syndication sponsors raising money from inexperienced passive investors and growing large portfolios at the peak of the market using very questionable financing, bridge loans, high loan to value ratios, all of that stuff. And it was really just a recipe for disaster. And now a lot of people are getting financially injured as a result of that unjustified euphoria in the market. Well, those wounds and scars heal slowly. So for operators that are professional real estate operators that have been in this business for a long time and are really offering a high degree of value to passive investors by bringing those systems, experience, knowledge, contacts, and everything to that investor's fingertips, are going to have a greater challenge raising capital than they would have if all of that hadn't blown up the way it did. And not because maybe their investors are upset with them, because they've probably done a great job through managing throughout this market down cycle. But a lot of these passive investors maybe invested across a few different operators that maybe weren't so good. And they may have lost money on some deals. They may have been wiped out on some deals. They may just be struggling on others or fulfilling capital calls. And, that kind of trauma doesn't get anybody excited about going like, when can I invest in my next deal? But there's still a lot of investors out there who understand, well, that was a market down cycle. We hadn't seen one in over a decade, almost a decade and a half. So it was inevitable that was going to happen. And if you're invested with the right operator who's very skilled at navigating those down cycles, then I think those investors will understand that, really this is a better time to be investing as a passive investor than it was at any point over the last 4 years for sure. And maybe even over the last 5 or 6 years, this could be a better time to invest. So, if you're especially a contrarian investor, but if you're an investor that really understands how these markets work, those folks are seeing this as an opportunity. And that's why, a lot of our investors are calling us going like, when are you guys going to buy something again so we can make another investment? There's still investors out there that understand that this is a really good time.
So if I'm an investor and I'm evaluating different syndications, right, or different funds, what questions should I be asking so that I can not get back into this kind of trap where I'm working with on the riskier side, so I'm working on the right fund and I'm investing into the right opportunities. So of course, as fund managers, as property managers, you take a lot of other responsibility. But as an investor, what should I be looking for? What questions should I be asking you or somebody else to say, okay, I want to work, I want to park my money over here?
That's a great question, and one that I would love to give your listeners all those answers to on this very brief show that we're doing. But the truth is that when I wrote The Hands-Off Investor, which is a book designed to teach investors how to invest in passive real estate syndications, it took me 350 pages to break down what exactly investors should be asking about their syndication investment sponsors. There's a lot that goes into this. And in fact, for the publisher, they created some bonus content for people that buy the book directly from the publisher. That's a list I put together of 100 questions to ask your real estate sponsor, because there really are that many. It's not like, okay, here's 5 things that if you ask these 5 things, then you're good to go, jump into the investment. There is a lot to consider. And this is a very involved method of investing where people think of the word passive investing and immediately believe that means that they can write a check or wire money and then sit back and, collect mailbox money. And it's a bit of a misnomer, because truly, when you're getting into one of these deals, it's anything but passive. You need to be very active about vetting the syndication sponsor and the deal that they're providing to you. And then it turns passive after you've made your investment. But let me give you some high level pointers, because I don't want to disappoint people with the good answer. I will go buy the book. There's more to it. I can give you something, right? There's an ongoing feud amongst folks who are on two sides of a fence of whether or not the syndication sponsor is more important to the outcome, or if the deal is more important to the outcome. Now, my personal belief, and I think this is probably backed up by performance of things over time, and I think that will hold out to be true, is that the sponsor is the most important element in the determining the outcome of the investment that you make in a passive real estate syndication, because a good sponsor can work their way through adversity and give you the best outcome possible in the face of challenge, as we've seen over the last 2 or 3 or 4 years. Although a bad sponsor can screw up a completely good real estate deal. So you got to keep that in mind and start your focus with drilling down on whether the sponsor that is bringing you this investment is someone that you want to invest with. What is their track record? How long have they been in business? Have they survived adverse market cycles before, and how did they survive it? What was their worst deal, and how did they handle that? Have they lost investor principal? And if so, what happened? And if not, how did they avoid it? Have they done enough deals where they're out of the rookie mistake phase of their career? How are they managing their properties, and what's the bios of the people that are in charge of those components of the business? Who are the players on this team, and what experience do they have, and what are each of their roles? And can the company survive without one of them? If is there extensive single person key man risk, where if one person in the sponsorship group is gone, then the whole thing falls apart because they're the glue holding the whole thing together? Or is there a depth of skill and experience on the team that would allow the venture to move forward to a successful conclusion minus one? So I would start there for sure. And once you've evaluated enough sponsors and you've figured out who's really good and that's who you want to invest with, then you start looking at the deals that they present to you. Now, if you've done a really good job and picked a good sponsor, they should really only be bringing you good opportunities. That would be part of the criteria of a good sponsor is you don't have to worry so much about the deal, because if they're a really good sponsor, they should be doing their job and bringing a good deal. Nevertheless, you want to look at that. What are the deal terms? What does that look like? And how are they underwriting it? And what assumptions are they using? And I've given you, 25 or 30 or 40 different things that you can look at, and you go like, oh my gosh, this is overwhelming. I don't know what a good answer is versus a bad answer. I definitely go into a lot of detail on all that in the book. If you ask this question, what should the answer be? That's some really, I think, valuable guidance for passive investors.
Yeah, to our viewers, definitely recommend buying that book to avoid those mistakes. One personal question I have, right? So people often get too greedy. Like, for example, a syndicator A brings in a deal at 10%, the syndicator B brings in a deal at 15, and the syndicator C brings a deal at 20. And investors' mindset is, okay, I'm going to get a better deal at, with syndicator C or somebody else or whatever that is. Let's talk realistically. Of course, there's always a jackpot that happened once in a while, whatever that is. Realistically, what kind of returns should the investors be looking at so they don't fall into this greed trap, which is very easy to fall into?
This is kind of a weird answer, but they really shouldn't be looking at the returns at all. And that sounds like a completely weird answer. Like, what do you mean? How could you possibly say that? That's ridiculous. But this is kind of like, I call this like the Amazon of real estate investing, right? On Amazon, if you want to buy a widget, you type in the type of widget you want to buy. You get a screen of all the different widgets that you can buy. You figure out like, oh, this one's the cheapest. That's the one I'm going to buy, right? I mean, so then came crowdfunding and created the Amazon of real estate investing, where you would go to this website, you would type in like real estate syndications, and you would get a screen with a grid of like 9 different investment opportunities that you can invest in. And it shows, what are the 2 things it will show? It will show the IRR, right? And, maybe one other thing. And so people look at that and they scan the list of 9 investment alternatives. They go, there's the one with the highest IRR. I'm going to pick that one. And that's probably the biggest mistake you can make, because the IRR that's shown as a projected return is 100,000% meaningless. It's completely made up through financial engineering and underwriting. Instead, what you need to look at is you need to look at the inputs that are creating these outputs. There's an old saying in computers that says garbage in, garbage out. And that completely applies to real estate syndication. If you go in there and you have an underwriting model that's plugged in at a too low exit cap rate, with a too high rent growth rate, with a too low interest expense, with too low of a expense growth multiplier, all of those things are going to collide at the same time and make whatever return is shown be completely unachievable. So instead, you should be looking at how the asset is being underwritten more so than the result that's coming from it. Now, assuming that all of the inputs that you're finding are reasonable, such as rent growth is supported by third-party reports that show evidence that there's, some PhD economists somewhere predicting that rent growth is going to be this percentage in this submarket, okay, fine. If property taxes are underwritten to a reassessed new valuation post-purchase at current mill rates, where you can see like, okay, these are going to be our actual property taxes, not the seller's property taxes, but our property taxes. Is it underwritten that way? Our insurance rates in here, is there a quote for the insurance to support the insurance expense assumption that's being made? All of those kinds of things. You want to see that the underwriting is really using assumptions that are based on some kind of a solid foundation. Assuming all of those are, then what you're looking for is a reasonable rate of return. Oh, and here's another big one. What is the debt leverage look like? That's a big one. And so with all of those kinds of things, what does the return look like? And is that return reasonable? And what you always have to keep in mind is you are looking for a risk-adjusted return. Now, this goes back to the financing element. Let's say you have two properties that are all underwritten using reasonable assumptions, reasonable and fair assumptions that are fully shown and baked in. All the fees are baked into the financial models. Everything is in there. And you've got one property that has a 20% projected return, and you have another that has a 14% projected return. Now, you might think, well, the 20 is better. And maybe it is, but maybe it isn't. Now look at the financing. Let's say to get to 20%, what the syndicator is doing is they're using 80% loan to value bridge loans. And then behind the bridge loan, they're putting in a tranche of preferred equity that has an 8% current pay and a 14% overall all in. And that's going to comprise another 10% of the capital stack. So now you're 90% leveraged, and your equity capital represents the final 10% of the capital stack. That's your 20. That's how they get to 20%. The other owner or the other syndicator is doing a 60% LTV agency loan with a 10-year maturity, no preferred equity, and is achieving a 15 or 14% IRR. Or is projecting a 14 or 15% IRR, which is better? Well, in my opinion, I would much rather be in the one that uses lower leverage because there's less risk, it's safer, you have more downside protection, a better ability to ride out a downside market, versus the other alternative with a 20% IRR and 90% senior capital stack, where any little hiccup in the market could cause you to be 100% wiped out very quickly. Now, if you're a super aggressive investor, you've got a lot of money, and you're basically taking a flyer, you're saying, if I lose this 50 grand, I don't even care. I'm just going to put it all on black and bet on it. And you like going to Vegas and all that kind of stuff, more power to you. And you could definitely make a lot of money doing that if things go your way. But if the market doesn't go your way, you could also lose it all. So you have to think about all of those things when you're making a decision and not just base it solely on projected return.
Awesome. Now, Brian, that's a section of our show where we talk about one fascinating story from your years of business. So, can you tell us about one positive and one negative story and how you overcome that?
Well, let's see. I guess a negative story would be the great financial collapse of 2008 and 2009. I had a property that I bought in Texas. It was 60 units. I paid half of what the previous owner had paid. Some guy bought it, and his intention, the market had already fallen some. He bought it. He was going to fix it up, renovate units, and rent them out for more. His plan completely backfired because he did no due diligence and didn't go into all the units and see how bad they were. So his plan fell apart. The property went into foreclosure. I bought it from his lender for half the price he paid, and I thought that was a brilliant move. What I didn't see coming was that about 6 months later, after I had finished doing a bunch of renovations, I got the occupancy up to about 99%. It was there for about a week when all of a sudden Lehman Brothers collapsed, Bear Stearns collapsed, the whole entire financial markets went into complete chaos, and the 2009 recession was running on full steam. And that caused our tenants to lose their jobs, and then they wouldn't pay, and we had to evict. And, I used to joke that, half the units were empty and the other half weren't paying. And it was a very, very difficult and painful time. And it was a struggle to get that property, back on track. And it took a number of years for the market to come back and allow us to finally sell that property and actually get out of it, thankfully at a profit, but not a very big one. So I think that was probably, I'd call one of the negatives. I'd say for positives, I have a good positive story, but it also has a negative component, which actually makes it kind of funny, is we bought two properties adjacent to one another from two different owners at two different times, about maybe 6 months apart. Each property was 250 or so units. Combined, they were about 540 units. So what we did is we bought the two properties, and then we combined them into one property. We combined the staffs. We closed one of the leasing offices because we handled it all out of the other office. And then that saved us like $300,000 a year in expenses, which, at a 5% cap rate, it was like a $6 million increase in value. I don't remember what the number was exactly, but it was a huge increase in property value. And it was an incredible opportunity. And then along came a fire that destroyed one unit. We recovered from that. 1 year to the day later, another fire. A few months after that fire, we had a hurricane that came through and threw trees into roofs and stuff like that. We overcame that. And then about 4:00 in the morning, somebody broke into the leasing office and threw a Molotov cocktail under the couch, and the leasing office burned to the ground. And then, so we had that challenge to overcome. So even through all those challenges and all that adversity, we managed our way through all of that stuff, and then ended up selling that property about, 2 years or maybe 3 years after we bought it, and made a humongous profit. It was something like we bought them, I don't know, it was like we bought it for 30 million and sold it for 60 in 2 years or something. The numbers were something close to that. It was a remarkable opportunity, an amazing return for our investors, and a very positive story with a very interesting bunch of negativity thrown in the middle.
No, definitely, you had a lot going on over there, and that tells me that you have that fighter mindset, right? So you're fighting with the challenges that are given to you on a daily basis, plus the economy, you know. So that's awesome. Finally, if our listeners want to learn more about you or your company, how can they get in touch with you?
The best way is through our company's website for Praxis Capital. The website is praxcap.com. It's praxcap.com. You can hit the Let's Talk button, fill out the form. That'll prompt us to send you a scheduling email to schedule a phone call if you're interested in learning more about what we do here. You can also find me on Instagram at Investor Brian Burke. You can check out the book, which you can buy from Amazon or bookstores, but if you buy it from the publisher directly at biggerpockets.com/syndication book, you'll get the bonus content, including some video interviews I did with other passive investors and the 100 questions to ask a sponsor. And you can also find me on biggerpockets.com and passivepockets.com in the forums, just answering questions for people who have questions about real estate investing. You can post questions in those question and answer forums, and sometimes I'll pop in there and with my opinion or answer on those questions as well.
Well, thank you. Thanks, Brian. Brian, it has been an absolute pleasure having you on the show today. Thank you so much for sharing your insights and experiences with us. And to all our listeners, thanks for tuning in to the episode of Bigger Life Podcast. If you enjoyed today's conversation, be sure to subscribe and review the show. Until then, next time, thank you.